Brady for his opening statement.
Well, thank you, Chairman Paul, Ranking Member Clay, members of the subcommittee. Before discussing the Sound Dollar Act, I'd like to acknowledge the work that Dr. Paul has done on this subcommittee as a long-time former member of the Joint Economic Committee to bring sound dollar to the forefront of the public debate. Inflation has been called many things: a hidden tax, a government-sponsored reduction in workers' paychecks, or, as Dr. Paul often says, theft. And more Americans understand the absurdity of a monetary policy that ultimately devalues our own currency. We agree on three key points. Preserving the value of the dollar is essential to economic growth and prosperity in America. The Federal Government must not be allowed to monetize its debt. And our financial system should serve the interests of all Americans, just not the interests of Washington and Wall Street. Again, I'd like to thank you, Chairman, for your steadfast commitment to bringing those issues to the forefront of the public debate. I'm pleased to testify on behalf of the Sound Dollar Act. I want to thank the members of this subcommittee who have already co-sponsored this important legislation: Mr. Jones, Mr. Lucas, Mr. Lukemeyer, Mr. Huizenga, and Mr. Garrett. The problem today is that, according to some, the 1800s was the British century, the 1900s was the American century, and the 2000s, 21st century, it may well be China's century. Well, not so fast. But for America to continue its preeminence in the global economy, it's important that we get the role of the Federal Reserve right. As we know, the Federal Reserve veered from the successful rules-based policies that brought the great moderation of the 1980s, 1990s, and instead adopted an interventionist approach that helped inflate the unsustainable housing bubble and led ultimately to a global economic crisis during the last decade. This interventionist approach, justified by the employment half of the dual mandate, continues today, and I believe it's a contributing factor to this anemic recovery. The Federal Reserve's interventionist policies are felt by the single mom who goes to the grocery store, finds her paycheck doesn't go as far because inflation is robbing her of the value of her hard-earned dollar, and she finds the same thing as she fills her gas pump as well. These interventionist policies are also felt by the unemployed. The uncertainty generated by the Fed's unprecedented interventions is discouraging business investment in new buildings, equipment, and software, which drive job creation in America. If you look at the numbers, government spending is where it was before the recession. Consumer spending is where it was before the recession. Business investment is not, and the Fed has played a role in that. For America to remain the world's leading economy in the 21st century, Congress must give the Fed a single mandate for price stability, ensure that it is independent from political pressure, and hold it accountable for results. Critics charge that focusing on a sound dollar implies the Fed will ignore the unemployment needs of America. They're wrong. America can only maximize our real output and employment with long-term price stability. Protecting the purchasing power of the dollar over time provides the strongest foundation for lasting economic growth and job creation. Critics also react as if a single mandate is a shocking proposal. But as we know, the United States won World War II, enjoyed 3 decades of prosperity, and put a man on the moon without a dual mandate. It's not a fundamental part of our constitutional fabric. It's a 1977 policy directive based on the discredited Phillips curve, and Congress can change it. While it may be politically appealing, the current dual mandate asks the Fed to do something that it simply cannot do. Chairman Ben Bernanke has testified before the JEC that in the long run, the only thing the Fed can control is inflation. In the long run, low inflation is the best thing we can do for growth. And a Federal Open Markets Committee statement said basically the same thing. The maximum level of employment is largely determined by non-monetary factors. Further, using monetary policy as a short-term tool to speed growth may actually harm the economy in the long term. Let me skip to the end and make the point here that among other provisions in the Sound Dollar Act, we grant a permanent vote to all the regional Federal Reserve Bank presidents because as important as New York and Washington is, there is much more to America's economy, and the FOMC should better reflect our geographic diversity. We require the Fed for the first time to articulate its lender of last resort policy in order to reduce uncertainty and incidence of moral hazard. We We speed the release of the transcripts from 5 to 3 years to create more timely information transparency. And we make sure the new Consumer Financial Protection Bureau is accountable to hardworking Americans by funding it the same way as other agencies do during Congress. Mr. Chairman, I've included my full testimony for the record as well.
I thank the gentleman. Now, Mr. Frank is recognized.